6 or 7 minutes on an update on the M&A market, and then Gaurav will talk to us about M&A accounting issues, and then we'll get started with the panel. So real quickly, we're a lower middle market investment banking firm. We handle M&A transactions, private equity debt capital raising, and most of the time we're on the sell side. Our clients are typically with revenue of 10 to 100 million or EBITDA of 2 to 12. About 75% of our clients are mature family businesses with no succession plan. We really strive in that environment. About 25% of our clients are emerging growth companies. Some key sectors for us: food, business services, industrial manufacturing and distribution. My partner Andrew Williamson is here. He is our go-to banker for tech deals and aerospace and defense. And then we also have another partner here, Sunil Joshi, who's our healthcare bank. We've had a couple of good years, 6 deals in 2 years, which is pretty average for us, 2 or 3 deals a year. We're kind of moving up the food chain every year. Our deals get a little bigger and bigger. So the most recent one was in December, business services company. And then we did a deal for a media company which produces investor conferences, a waterworks distribution company, chemicals manufacturing company, quantum networking company, and a packaging business. So I mentioned Sunil and Andrew. So what happened in 2025 in M&A? It started out just like this year is starting out, very, very optimistic. So I'm a little bit nervous. But obviously there was tariff issues. Come Liberation Day, everything stopped for about 6 months. Thank God. Fourth quarter, things kind of settled down. The M&A market really started to come back in the fourth quarter. It's starting to dissipate a little bit, but you still have buyer-seller valuation. Yeah. A lot of sellers are stuck in the valuations of 21 and 2022. That's not something that kind of comes and goes every couple of years. That's like an every 10 or 15 year dynamic. So, you saw that, probably in 06, 07 before the global financial crisis. So it took another 15 years or so before you saw those huge spikes in M&A activity as well as multiples. On the positive side, interest rates were lowered a little bit. GDP growth remains solid even to this day. There's still tons of money out there looking for a home. But really the theme of 2025 was the mega deals. The middle market, was very choppy. What we're seeing so far this year is the lower middle market is starting off very, very strong. So knock on wood that continues. So the lower middle market has some kind of catch up to do. Kind of talked about this already. So PitchBook has some great data, and in 25, you see that North American M&A activity from a deal count perspective was up 10%, but from a value perspective was up 52%. So what does that say? That tells you that there were a lot of big deals that really drove the market. And that's why, in general, from a professional perspective, we always focus more on deal count because it's really more indicative of activity, because valuation can be a little misleading. So the stronger sectors, B2B, did well. That's the largest sector in M&A. The sector that did the best from a percentage basis was healthcare. So they kind of started from a low base, but healthcare did well. Tech obviously did well. So if you look at the B2B sector, the divergence between deal count and deal value is really evident here. Deal count actually decreased 10%, while the value of deals increased. If you look at the B2C sector, very similar. Decreased 14% in deal count, increased 36% in deal value. There were a lot of really, really big deals last year. From a tech perspective, deal count up 1%, deal value up 36%. Healthcare, deal count down 14%, value up 50%. Again, some very large deals. Oops. So now tracking the private equity activity, somewhat similar. So from a year-over-year perspective, deal count was up 12%, deal value up 38%. So very sort of similar dynamic with private equity. So one of the interesting dynamics right now, everyone hears about, the bubble in private credit. I honestly don't believe there are a bunch of cockroaches that are hidden. I'm biased though, because I like private credit and they're good for our business. But one of the implications of that much private credit, and you'll hear from the panel, if they need debt for a deal, they can get it in a heartbeat. They can get very attractive rates. They are very competitive terms. And this is an example. So a couple of years ago, if a sponsor wanted to buy a company, they'd have to put in more than half of the deal in equity. Today, it's down to 46%. May not sound like a big drop, but that's a pretty big drop. And then multiples. This is always one of my favorite charts. And I use this to manage owners' expectations on a regular basis. Basically, this is from GDF data, which is part of ACG. It basically tells you two things. It shows you the trends of valuations from year to year, but more important piece is smaller deals generally get traded at lower multiples than larger deals, and that's because larger deals are less risky. So that's it. Thank you for being here. We're excited to have you here. We've done this event now 13 years in a row, and I'm super excited to introduce Gaurav Malhotra from Lucas